We are into episode 4 of the Who Wants to Be an FP&A Ninja quiz, and I welcome all of you. There are about 40 plus people on with me playing this today, and more people are joining as we speak. Quick shout out about my new book, From Accounting to FP&A, which is launching on 27th of July. So do check that out. Quickly move into the quiz objectives. So, as you know, the objective of this quiz is to increase awareness about FP&A and attract more talent into the FP&A roles. Also, helping people to understand FP&A concepts in a way that is fun and easy to learn, encouraging continuous learning. So a lot of people don't go back to books and colleges after they are done with their professional certifications or college degrees. This is a good way to encourage continuous learning and also networking. So to do that, I would request, if you can, please do come on camera and let others see who is the face or who's the face behind the names. And you never know, you might meet somewhere in person and you might be able to connect based on this group. That's on the objectives. Quickly, I will also talk about the rules of the game. So there will be a link shared in on the screen along with a QR code. So you can either use the link or the QR code to get to the game and use the game pin. Also, you will need to put your name. Make sure you just don't put your nickname or your first name. Make sure you put your first name and the last name. If there is a limitation on characters, make sure you use your first name and then first few initials of your last name. In case you drop out, you can rejoin using the same pin. So the pin will be displayed at the bottom of the screen throughout the quiz. And if you drop out for some reason due to network or any other issues, you can rejoin using the same pin. However, any questions you missed, those points will not be added back to you, or you'll lose out on those points. Yeah, be on camera if possible. I already mentioned that. I will put everybody on mute to avoid background noise, and we can unmute after the quiz is over for a quick 15-minute Q&A. So we should wrap this up by 9:30 and then we can use the last 10-15 minutes for the Q&A. Okay, so let's do the trial round, or let's do the warm-up round. Let me stop sharing my screen and let's see if we can get into the trial round. Okay, it'll take me about few seconds to log into the app, so please bear with me. So I'm just logging and connecting the Kahoot app to Zoom now, and that usually takes about few seconds. Okay, so it looks like I managed to log into the app and it is now connecting to Zoom. So there's an integration which works to connect Zoom, and it is asking me the permission to connect Kahoot to Zoom, and I'm approving that. And hopefully it should now appear and we will do the trial round. Okay, so let me open a past quiz episode so that you can get a feel of how it looks like. And you will see a screen coming up where you have the QR code and the link. So it should come up right now. So let me know in the chat box if you see the QR code and the screen. So it should come up in the next few seconds. Okay, coming up on your screen. Thank you for your patience, and you should see a QR code. Remember, this is a trial round, so you're just testing out the application. Let me click on the start. This is episode 1. We are just doing the first question to understand the application, especially for people who are joining us for the first time. So you see the app link, which is www.kahoot.it. You can either go to this link from your mobile phone. Alternatively, the second option is you use the QR code. You use your QR code scanner, scan this. This will take you to the same site and you can use the game pin and enter the game. Okay, I see 15 people or 12 people, 13 people have already joined. When we do the main quiz, you will get 60 seconds to join and then we will start. Okay, so I see a lot of people have joined. We'll give it another 15 seconds and then start the trial round. Okay, so 22 people have joined, maybe another 10 seconds and then we'll start the trial round. Is the music audible? Is the music audible? The background.
Yes, Asif.
Okay, perfect. Let's start with the warm-up round. So this was the episode 1 which we did 2 weeks back. So the question will be there on your screen, on your computer screen. I will read out the question and you will see 4 options on your mobile phone, and you have to select the right color or the right shape. You have to match the color and the right shape. based on whatever option you think is the right option. Also note that there might be some trick questions. Trick questions meaning you might feel that two or more options are right. In that case, you have to select the most appropriate answer. So if there are two right answers, there might be one answer which might be more closer or which might be more appropriate than the other one. So there might be a couple of questions where you might feel there are multiple options are right options. In that case, you have to pick the most closest right answer. Okay. So that was the trial round. We'll go to the main quiz now. So let me go to the main quiz and I'll launch episode, which is today's episode, which is on ratio analysis, and we'll go and play that. Okay, so coming up, you will have 1 minute. So right now it is 21:18 or 9:18 in my watch. We will start the quiz sharp at, we'll give it maybe a few more seconds. So we'll start at 21:20 when the clock hits 21:20. So we'll start at 9:20 sharp. Okay, so you see the game pin, you see the QR code, you see the link. Use the link and join the QR code. Use the QR code and join the link and enter your first name and the first few initials of the last name if possible. Please don't use nicknames. We may not be able to trace you if you win by your nickname. Okay, so 16 people have joined and we have, I believe, 45 more seconds. So we'll let other people join. There are how many people here in the group? There are about 40 people. So we'll wait for another few seconds. Is anybody facing issues joining the link? Let me know in the chat box. Anybody trying to join but unable to join? Okay. So what I would recommend is you use your so you use your mobile and you go to this website again. So you try it using another browser. So if you're using say Chrome, you try using Firefox or you try using Safari. So just try using a different browser and go to this link and try joining again. Okay, so 31 people have joined and I believe we are about to start. So as soon as the clock hits 20, we'll start. So it is already 9:20 and resend the link. Okay, so let me just type the link in the chat box. I'm just typing the link in the chat box. You have to use this link. When you go to this link, you have to key in this game pin and then you can start playing. Okay, so we'll start in the interest of time. 10 questions. Hopefully, we should get through this in the next 15 minutes and we will start now. So remember, the quiz is on ratio analysis. Hopefully, you have done some homework, you've done some pre-work on this topic, and let's see how it goes. Okay, so the first question will come up soon. The question is, what does a debt to equity ratio, of 2:5 indicate? And you have the options on the screen. Okay, so I see that most of you got the answer right. Whoever answered, 14 people out of the 20 odd people or 25 odd people got this right. So the right answer is, it means that the company has $2.5 of debt for every $1 of equity. And we'll talk more about this in the coming slides. But before that, quick look at the leaderboard. So on the leaderboard, you will see the top five people who are leading. And usually what happens is this will change with every question. So if you get an answer right and somebody gets it wrong, or you answer it faster, you will climb up on the rankings. Also, the faster you answer, more points you will get. So somebody who's answering it in the first few seconds will get more points than somebody who's answering in the last few seconds. Okay, so with that, let's go to what debt to equity ratio is before we go to the next question. So your debt to equity ratio of 2:5 here means that the company has $2.5 of debt for every $1 of equity. We already saw that. So the formula for debt to equity ratio is your total debt divided by total equity. and a higher debt to equity ratio usually suggests that it has or the company has a higher financial leverage and potential risk, as it is relying more on debt financing versus equity financing. Okay, so that is on the debt to equity ratio. With that, we'll go to the next ratio or the next question. Let's see what that is. So, what does the price to earnings or the PE ratio signify? Okay, good to see most of you got this right. So, it is a ratio of a company's current share price to its earnings per share. And we'll see more on this after the leaderboard. So, you see some changes, ups and downs. Still early. We'll come to the leaderboard once we get to the end or closer to the end of the quiz. So, Veer, Gaurav, Venkat, Karthik, and Hari. Yeah, good luck to you guys and good luck to others as well. So, we've seen this change in the last question. So, keep on it and make sure that you answer the right question as soon as you can. So, the PE ratio is your it is used mostly commonly or most commonly used to compare companies within the same industry. So when you're valuing the companies within the same industries, you use the PE ratio, and it's a valuation ratio. And the formula for that is your share price divided by earnings per share. And usually it is used for valuing and comparing in the companies in the same industry or the sector. Okay, with that, let's go to the next question, which is on what does a high inventory turnover ratio indicate? And you have the options on your screen. Okay, so I see some of you got, okay, many of you got this right and some of you got this wrong. So the high inventory turnover indicates that a company is efficiently managing its inventory or selling its inventory quickly. We'll see more on that. Before that, let's see the leaderboard. So some changes. Gaurav is on now first position, followed by Hari, followed by Sachin. Ornella is now in the top five, followed by Vinod. So congratulations to those who just joined the leaderboard, and let's see what the inventory turnover ratio is. So this is how it is calculated. You see the ratio on the screen. It is cost of goods sold in the numerator, divided by average inventory in the denominator. And high inventory turnover usually indicates that a company is efficiently managing its inventory. On the other hand, a low inventory turnover ratio might suggest that the company has overstocked, has obsolete inventory, or has weak sales, which can lead to higher cost on storage and also potential losses from unsold or obsolete inventory. Yes, so you see, if you just in case if you drop out and you want to rejoin, you can use the game pin on the bottom. So the game pin is also displayed at the bottom of the screen here. Okay. And yeah, the game pin is shared in the chat box. Thank you. So let's go to the next question, which is, I believe, question number 4 out of 10. Let's see what that is. Which ratio is a company's ability to generate profit from its shareholder equity? And you have four options. Okay, so let's see how many got this right. So almost all of you got this right, and the right answer is return on equity. We'll see more on that in the coming slide. But yeah, I think more or less the leaderboard situation is some same, no significant changes. So we'll come back to it in the next question. Mohammed is asking in the chat box what kind of trial is going on. So we are playing a quiz, Mohammed. Feel free to join the quiz. You can join it using the website that you see at the bottom, and you can use the pin which is also flashed on your screen at the bottom of the screen. Okay, let's move to the next question, which is okay. Before that, more on return on equity. So, how it is calculated? It is your net income in the numerator and shareholders' equity in the denominator. It indicates how well a company uses its funds, basically funds that are shareholders' funds to generate earnings. A higher return on equity usually means that the company is effectively using the shareholders' money to generate profit, reflecting strong financial performance. On the other hand, a lower return on equity might indicate that it is using its shareholders' money less effectively. So that's on the return on equity. With that, we will go to the next ratio or the next question. And the next question is on your screen now. What does the cash conversion cycle measure? What does the cash conversion cycle measure? The right answer is option A, which is time taken to convert its raw materials into cash through sales. And we'll see more on that in the coming slide. Before that, let's look at the leaderboard. Okay, so some changes. I see K side coming in at fifth position, and the other four are as is. So let's see what happens in the next question. We are, I believe, at the midway stage, so we have five more questions to go, and let's see what happens next. Before that, let's take a look at the cash conversion cycle. So it is the number of days between the time that the company disburses cash to pay its suppliers and when it finally receives money from its debtors or customers. So it's the time period between that, and usually it's calculated as your days in inventory plus the days sales outstanding, and we'll see more on this in the coming slides, minus the days payable outstanding. So this is the formula. And let's take a look at an example. So let's assume that this is a company which takes 54 days to sell its inventory. Once the inventory is sold, it takes 15 days to collect payments from its customers. And then it pays its suppliers for after 30 days after purchasing the inventory. So in this case, the cash conversion cycle will be 54, which is your days in inventory, days in hand inventory, plus your days sales outstanding, which is in this case 15 days, minus the days payable outstanding, which is 30 days, and your net cash conversion cycle will be in this case 39 days. Okay, so hope that gives you an idea of the cash conversion cycle. And with that, we will go to the next question. So, what does the days sale outstanding measure? So, we just talked about it. What does it measure? Okay, so the right answer is the average number of days that takes to collect payments after a sale has been made, after a credit sale has been made. That is the right answer, and we'll see more on that in the coming slide. Before that, let's take a look at the scoreboard. Okay, so Hari is now on top, followed by Gaurav, followed by Sachin, and K and Ornera are on fourth and the fifth position. Also, it says that Anwar has answered six questions back to back right, so he has a winning streak. So let's see what happens in the next question. Be careful now, slightly the questions might get trickier, slightly difficult. So make sure you read the questions rightly. Don't get confused. Read the questions rightly or read the questions carefully, as I would suggest. Let's go to the next question. Before that, on days sale outstanding. So it is what it measures is the average number of days it takes for a company to collect payments from its customers after a sale has been made on a credit. So that is what the days sale outstanding is. And you see the formula on the screen. It is your accounts receivable divided by credit sales into the number of days in that period. So if you're calculating it for 1 year, it will be 365. And if it is for one quarter, it will be 90. So based on the period, you will multiply it by number of days. Now, what does it indicate? Your days sales outstanding. If it is high, what it means is that company is taking long time to collect or longer time to collect its receivable, which may signal issues with its credit policies or collection efforts. Okay. So that is what it indicates if the days sales outstanding is higher. On the other hand, if the company has a low days sale outstanding or a low DSO number, what it would suggest is that the company is collecting payments from its customer quickly, and generally it reflects to good, efficient collection process or good credit control is what it says. So that was on the days sale outstanding. We are coming closer to the end, and we'll get to the next question quickly. So, what is the primary purpose of return on capital employed, ROCE? Okay, so the right answer is it is to assess the efficiency of generating profit from capital employed compared to the other option. This is the most correct option, or this is the right option. We'll come to more on the ROCE ratio in the coming slides. Before that, let's see what has happened on the leaderboard. So, yes, Gaurav is back on first position, followed by Sachin, and you see some changes, some ups and downs there. But make sure you are closer to your mobile, closer to your screen. We have last few questions coming up. And before that, let's take a quick look at the ROCE ratio. So, how it is calculated? It is your earnings before interest and tax divided by total capital employed. So, total capital employed includes your both debt and equity. And usually, a high return on capital employed will indicate that the company is efficiently using its capital, which is both the debt and the equity, to generate profits, which is a positive sign for shareholders and investors. A lower return on capital employed would suggest opposite. So it may suggest that the company may not be using its capital effectively. So that was on the return on capital employed. We'll go to the next ratio or the next question. What does the receivables turnover ratio measure? What does this ratio measure? Okay, 5 more seconds. Okay, so the right answer here is the efficiency of converting account receivable into cash, which is strange. The average number of days. So I mentioned, right? So what does it measure? So it measures the efficiency of converting account receivable into cash, which is the more right answer. There might be couple of two or more right answers that you might see. However, you have to pick the most correct one or the most closest answer. So we'll talk more about the receivables turnover ratio, and we'll come to it in the next slide. Before that, let's see the leaderboard. So some changes here and there. I think first position is Bharat, followed by Gaurav, and then Sachin, K, and Ornella. Okay, I see a comment at the bottom. Combo breaker. Okay, what is that? 5 players just dropped their streak. Okay, so seven. So many of the participants were answering right, or they had seven right answers back to back, and this was the break in that. Okay, let's go to the next one. Remember, you if you see two right answers, you have to pick the most relevant one, which is the again related to the question, and pick the most right answer if you see two or more right answers. Okay, let's go to the next question. Before that, receivables turnover ratio is your net credit sales divided by average accounts receivable, and it measures how many times a company collect its average accounts receivable in a given period. Usually, a high receivables turnover ratio would mean that the company is effectively converting its receivable into cash, while a low accounts or low receivables turnover ratio may suggest that there might be some issues in collecting money from its customers. That is what the receivables turnover ratio is. and we will go to the next question. Okay, now this is on the asset turnover ratio. What does a low asset turnover ratio indicate? Okay, the right answer is a low asset turnover ratio means that low efficiency in using assets to generate sales. Okay, and we'll see more on that in the next slide. Okay, so some more changes. However, the top five are still the top five. So let's see if this changes. And we are coming very close to the last question. In fact, we are on the second last question now. So two more questions to go, what I believe, or maybe just one question, right? Yeah, let's see. So let's go to the last or the second last question. I don't remember. So let's go to the next question and we'll come back to the leaderboard. Asset turnover ratio, as you see on your screen, is your net sales divided by average total assets. A high asset turnover ratio usually means that the company is using assets or its assets to generate revenue, while a low asset turnover would indicate that the company is not effectively or comparatively not. If you're comparing two companies on asset turnover ratio, the company with a lower asset turnover ratio is not using its assets effectively to generate sales. Okay, so that was on the asset turnover ratio, and that brings us to almost the end, which is the last question for today. What does the revenue per employee ratio indicate? Make sure that you pick the most right answer. So you might see two or more right answers. Okay, so as I mentioned, the closest right answer or the intent, I mean, what does it indicate is the efficiency of generating revenue with it was workforce. So that is what you are measuring using revenue per employee. The total revenue divided by total number of employees is just the formula. So you are more looking on the indicator of what does it show. So yeah, both are right. However, what the as per the question, this is what it indicates, meaning this is what the ratio tells you that the efficiency of generating revenue with its workforce. Okay, so that brings us to the end of the quiz. And any guesses who will be the winner? So let's guess in the chat box who would be on position one. Okay, so Sairam is saying himself. Okay, Karthik is saying Gaurav. Okay, Naveen is saying Bharat. Chandrakant is saying Gaurav. So couple of people Gaurav, and so it's between Gaurav, Bharat, and Sairam. So let's see who's won this. And we start with the third position. And let's see who's on the third position. So we have Bharat on the third position. Congratulations. Followed by Gaurav. And on first position is K Sai. I believe this is Sai Ram. So congratulations. So he guessed it right. Maybe he answered it very quickly. So he was so confident. Okay, so that brings us to the end of this episode. Let me go back to my slides. Okay, so quickly, winners, what they get, and most of you know this. So fourth and fifth position gets the foundations bundle. The second and the third position gets the FP&A Launchpad bundle, which is our curated self-paced version of the live FP&A program that we do every quarter or every other month. So this is the self-paced version of our or the best collection of our live program that we do. And the winner or the first person who's won it gets the bundle, the self-paced version, plus a full scholarship. So this probably needs to change. A full scholarship to the FP&A masterclass, which is more than I think together this value will be more than $400. So congratulations to the winners, and looking forward to the next episode. Okay. Also, as you know, we open this code on Thursday. So if you want to get the bundle, or if you want to buy the bundle, you can buy it at a 70% discount during the Thursday period until the midnight. So it's until the 25th of July midnight, and you can do that. I'll drop the code if you are interested in buying that. And with that, it brings us to the end of today's episode, and we will again meet for the next episode, which will be on capital budgeting on 1st of August, which is the next Thursday, and we'll see you again then. So that, let me stop sharing my screen. And as I mentioned, so there's an opportunity to get a free copy of my book as well as the FP&A Launchpad for those who drop the best description. So let me just share the link of the LinkedIn post in the chat box. So what this will do is this will also help me promote my book. Also, it will give you an opportunity to get a free copy of my book and the Launchpad bundle. So let me just share that now. Okay, so that's the end of today's session. We'll stop here and see if there are any questions. Yeah, go ahead, Viral. Your question. I see it in the chat box, but if you want to unmute, go ahead.
Hey, hi, Asif.
Yeah.
Thanks. Another great session. Enjoyed it again.
Thank you.
When I have query with respect to this inventory turnover.
Mm-hmm.
There are many companies do it slightly differently in days and in times. So if you
Right.
go by days, higher the days, lower the efficiency of converting that, by which the first answer seems correct.
Okay.
And in the other way, number of times, which
Right.
means the answer in your this thing was correct.
Mhm.
And that's where I mean, I was in dilemma. And obviously, the industry in which I am into, we are calculating in days. Higher the days, it's not
Mhm.
efficiently managing the inventory, and that's why I choose that answer. But I just want to understand. I mean, what is the industry scenario? I mean, how default? What is the measurement of inventory turnover?
Yeah, so you can do it both ways. The one way is you measure it by times or multiples, and the other way is you calculate it by days. So both are actually linked and both are opposite of each other. So you can do it any one of the two ways, and both the ways are very popular. So you can either calculate the days inventory outstanding, which is in number of days, or the inventory turnover ratio, which is in the multiples. So you can do both ways, whatever way you want to present it. Both ways are right, and I've seen both. So one is called the days. So if you calculate it in number of days, it is called DIO, or days inventory in hand. And if you calculate it in multiples, it is called the inventory turnover ratio, which is maybe 2x or 3x.
Got it. But just last question or follow up one.
Yeah.
Is it good to have two different things, like for raw material measure it on days, and for FG measure it on times? Does that mean number of times more FG, it's better for company? Lower the days for raw material, again it's also better for company, right?
Yeah, actually both are the same things. You're just presenting it in a different way. So if you want to show it as a multiple or number of times, you would use that. If you want to show it as number of days, you would use the days inventory.
Correct.
So
I
both
agree. But what I'm referring is from a controller's perspective or FP&A perspective. To present the numbers to stakeholder, what is appealing for stakeholder? And again, I mean, that's what I mean. I'm just going by my logic that for investors, times for finished good inventory, it's more appealing than looking at days. And for raw material presentation, the days probably I feel appropriate to show them rather than showing them in times. So is it right to assume, or I mean to present?
Again, see, it'll depend on what you want to convey as a message. So if you want to suggest, I mean, again, it's on the presentation. So it doesn't depend on the type of the raw material or the type of the category. It's more on if you want to show that what multiple or how efficiently your inventory is moving as a multiple of your cost of goods sold, then you use
Mm-hmm.
the the inventory turnover ratio. If you want to show it as how many days of inventory you need in hand, I think the second one, which is days in inventory, is more relatable to non-finance people because they can see, okay, 45 days, 50 days. What it means is
Mm-hmm.
it will take 45 days for the company to sell the inventory. So usually I've seen the second one being used more inside the company when you use it for the senior management.
Okay.
But when you use it for analysts and external stakeholders, you use the turnover ratio because that is more popular convention for analysts and people who are outside the organization.
Okay. 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 Thanks. Noted.
Okay, so there's another question in the chat box. Hi, Gaurav. Is obsolete inventory need to be taken into consideration while calculating the inventory turnover ratio? So, if your question is that should we remove that, I don't think so. We should remove that. So that, I mean, that is the purpose of the turnover ratio. You have to figure out what is the slow moving. I mean, if it is, if the ratio is higher, then probably it will tell you that it has obsolete or it has slow moving inventory. So I don't think so. It would be right to remove the obsolete inventory. But yes, if there is something that has been, I mean, in outside your normal uh, operations, say if there's some inventory lying from last 20 years and you want to just exclude that just to make sure that there's a like to like comparison. Usually the obsolete inventory might be 6 months to maybe 2 years, but there is some inventory which is there from 20 years. I don't know why, but that could be an exception where you want to just compare the most recent inventory versus something which has been there for maybe 5 years, 7 years. Okay, however, in general, I would not. I mean, mostly I don't see people removing any obsolete inventory, but I am happy to see if there are any contrary opinions as well, because this could be a debate or a topic for debate. Okay.
Uh,
Yeah.
I as if I have again not an opinion, but I
Yeah.
mean the practice. So what we have is every month. Uh, Again, the company is a Danish company. Again,
Mm-hmm.
it's ex organization though.
Mm-hmm.
Uh, we used to do a inventory depreciation every month in books of account, and while presenting the net inventory to the stakeholders and also to
Mm-hmm.
the senior management, we used
Yeah.
to present the net inventory only to them, because
Right.
financially the depreciation happens every month, and that too, I mean, there were three or four parameters. Inventory more than 2 years at 25%, more than 3 years 75%, and more than 4 years at 100%. So that there is no
Okay.
immediate hit, there is a monthly hit. So again,
Right.
just an opinion actually,
Yeah.
that
Yeah. So
how I have observed.
absolutely. So you're showing on presenting the inventory number, right? Here the question is on the ratio. So when you present the inventory, you might write off the old inventory. Maybe depreciation may not be the best term. Maybe written off or
Writing
writing
off,
it off.
yeah,
Yeah,
correct, sorry, my bad,
yeah.
yeah.
So you might write off the inventory which is obsolete or old while you present it. But when you calculate the purpose of calculating that ratio is to identify slow moving inventory or obsolete inventory, or measure the company's inventory turnover compared to some other company. So when you calculate the ratio, you may not exclude it, but in your case you're presenting the inventory number, so in that case you may want to.
I have a request, Asif. For, I mean, inventory again. An area for most of the FP&A
Mhm.
to do better for an organization, bring more value to the table for stakeholders and everybody, and be real business partner. Would request you. I mean, some sort of session in terms of helping supply chain team in managing
Mhm.
inventory. What are the parameters? Being a business partner, the FP&A guy can help organization how to look at the numbers with respect to the demand supply planning, making sure that we have right inventory, and along with the latest trends, not latest though actually, but
Mhm.
vendor managed inventory and GIT and so on, so that I mean that there are good amount of value addition for the organization from FP&A as a partner side.
Yeah, definitely. So I'll take that as a feedback, and we will add it to our I mean request, and we'll come to it at some point in time, definitely.
Super. Thanks a lot.
Thank you
Thanks.
so much. Okay, so that brings us, okay, there's one more question. What is capital employed formula? So capital employed, I mean, in general terms, what I've seen is you use both debt and equity. So you add your debt and equity, and that is your total capital uh, employed. Could you differ? I believe you already covered that DSO and the receivable. So it's very similar to DIO and the inventory turnover ratio. Your DSO, or the days sales outstanding, is your number of days, and your uh, debtors turnover ratio or the receivable turnover ratio is the multiple or the number of times. So very similar to the inventory days in hand and inventory turnover ratio. Okay, so I think that brings us to the end of today's session. Any last question that I can answer, or we can take? Love to take that. If not, we'll meet again next time. And do watch out for my book launch, which is happening on 27th of July, couple of days from now. And do check out its contents, and if you feel it's a good book, I believe it will be a good book for people who are looking to make that transition. Do consider buying that from Amazon. So thank you so much. Thank you for joining, and I will see you again in the next episode, which is next Thursday. And the topic will be capital budgeting. So make sure that you brush up your uh, skills on capital budgeting, and we'll come again and meet next Thursday. Thank you so much. Thanks, everybody.